Janet Yellen's last Fed meeting and the prospect of rate hikes in the coming months. Our global economics and policy editor Kathleen Hayes back. We can also joining us is, of course, former Richmond Fed President Al Broaddus. So, Kathleen, just very quickly set the stage for us on what we heard from Janet Yellen today.
Well, we didn't actually hear from Janet Yellen, no press conference, but we did get a policy statement that had important tweaks, Betty. Tweaks where they talked about further rate increases coming, whereas adding the word further, and tweaks to the inflation outlook, which make it sound like they're a little more confident than they were a year ago, that they're going to eventually head toward that 2% target, even adding the word solid to describe growth. So, Al, I know you were looking at these things in the note you sent out. Are you confident that the Fed will get higher inflation this year and that at least 3 rate hikes are justified?
Well, I think it's still an open question, as always, with these things, Kathleen. But I have to believe that the recent data, the way the market measures of inflation expectations have been behaving, certainly the probability that inflation will rise at a faster rate, I think, has increased. And I think that's what this statement reflected more than anything else. Concern about the possibility that inflation would not move up to target over the last several months has, I think, been one of the things holding the Fed back a bit. And I don't mean to imply that the Fed's now going to go for broke and raise rates really aggressively, but I think what this means and what they signaled today is that there seems to be a greater comfort level that inflation will rise to target, which means that rates will begin to move up. You know, they've signaled 3 increases, I think, sort of, unless something very different from what we expect happens in March, they're almost certain to increase rates then. An issue has been, will there then be 2 more or 3 more this year? This doesn't answer that question, but I think the statement today suggests that the odds now are higher that you'll get maybe even 4 increases this year. You
know, our attention is off the yield curve since we started this teddy bear bond market sell-off, right? A soft sell-off. But the question is the yield curve nevertheless, because it's gotten a little less flat. It's steepened a little bit. Fed keeps tightening. If they go to 3 and maybe even 4, what does that do to the yield curve? Is there a risk it inverts? And isn't that dangerous?
You know, it's a fair question, but I guess my thought is that it won't. You've got, you know, flatness. There are different behaviors of the different rates, but I would expect to see if this signal occurs, and if in fact you do get some suggestion of higher inflation, I think that's going to be reflected in a somewhat higher 10-year, and I think that you know the yield curve's slope may not change much, but I don't see, unless there's really aggressive tightening, you know, an inversion of the curve. I think that's a remote possibility.
Al, is any of this, though, going to start to reverse the downward, the downtrend that we've seen in the U.S. dollar?
You know, it would tend to do that. There are lots of other things going on in foreign exchange markets, as you know. And of course, there are 2 sides to the story. That's what's going on in the U.S., also what's going on overseas. I think the prospects of higher rates overseas, perhaps especially in Europe, are one of the things that have been holding the dollar down. But certainly, you know, other things equal, what happened in the meeting today and the statement that was released would tend to put upward pressure rather than downward pressure on the dollar.
You would think so, right? We certainly haven't seen rate hikes as of late putting that pressure, but you know, but if these forces continue, perhaps so. Al, what do you think are going to be the key things that the Fed is going to have to be watching in the next few months?
Well, I think it's going to. I think much of the focus will be on the inflation signals. They'll be looking at the inflation data that comes in, but they're also going to be looking at things like break-even spreads to get some sense of where market expectations are going. Of course, the inflation rate is influenced. You know, we have a very tight labor market. That the linkage between labor markets and inflation seems now to be weaker than people used to think it was, but there's probably still some linkage. So if you continue to see the strengthening in underlying economic growth, That may tend, other things equal, to give some greater tightness to the labor market, perhaps some upward push to wages. That could cause some rise in inflation or inflation expectations. So those are the things, I think, that the committee will be focusing on in the months ahead.
Yeah, certainly inflation is going to be one, Al, but also with this budget deficit. I mean, the U.S. is said to be issuing more debt as they kind of try to counter this mounting budget deficit of $1 trillion thanks to tax cuts. How do you think Jay Powell is going to have to react?
Well, that of course, would, other things equal, would tend to put upward pressure on market interest rates as the Treasury demands more credit in debt markets, and that the Fed will have to respond to that, and that would, if those underlying pressures become clear and obvious, I think the Fed that again tends to increase the probability of a somewhat more rapid increase in Fed policy rates. But again, I don't think I wouldn't want to carry this too far. There's still, the impact of the deficit on Fed policy is not likely to be immediate. That's more likely to be a longer-term influence and maybe pushing rates up over the longer term.
Al, I want to ask you about the new personnel and the rotation of voters on the FOMC, because the three Fed bank presidents who are going to be voting tend to be a bit more hawkish. Someone you know fairly well, Marvin Goodfriend, former director of research years ago at the Fed, at Richmond Fed, that is in line potentially to be on the board. Broadly, is this going to incline the Fed more towards getting on with those rate hikes, maybe moving for 4? And in particular, what kind of governor will Mr. Goodfriend be?
I think he'll be an extraordinary governor. I do hope that they still have to vote to confirm. That hasn't occurred yet, and I certainly hope that it will. Marvin is a truly brilliant Federal Reserve economist. I worked with him closely for about a quarter of a century, and he's in the time since, about 10 years, he's continued to study the Fed from his position at Carnegie Mellon. But he has a long, deep understanding of Fed policy and its history and what needs to be done for the Fed to make a contribution to the economy and to help hold inflation down and provide the kind of monetary stability we need to have a strong economy. So he would be a terrific addition. I don't think so much in terms of whether he's going to be a hawk or a dove. I think he's going to look at the data that he has to deal with. But the main thing he understands is that the Fed needs to maintain its credibility with the public and with financial markets. And I think he'll be someone who will ensure that that takes place if he's on the Board of Governors.
All right. Well, Al Broaddus, thank you for joining us. We know you had a little bit of a hassle getting to the studio, and we're glad you hung in there for us. Thanks again, Al. It's always great to have you with us. So, Betty, there you have it.